Hi, and welcome to this episode of Financial Planning Innovation. I'm Mark Lichtman. I'm an actuary by background, and it's my pleasure to have on the line Chris Grande. Chris is a comprehensive financial planner. He's going to share with us some secrets and some tips to liability-driven investment today. Thanks for joining us.
Thanks for having me, Mark. I appreciate being here.
So how did you get into the financial planning space in the first place?
Fell into it by accident. Wanted to be Peter Lynch. Ended up being Peter somebody else. I happened to alumni from my school got dragged me into the business, and somehow I just fell into it and been here for 25 years.
Wow. Okay. So today, what does your practice look like? How do you work with clients today?
Small number of families. We do total comprehensive financial planning. I've developed a team of people over my 25 years in business to pretty much handle every area. So we structure what's effectively a family office for people with less than $1 billion. A real family office. The only thing I don't do is if your drunk kid is in jail, I'm not going to go down there and bail them out. But other stuff we do, try to handle the entire financial picture.
Awesome. And so today we're going to talk a little bit about risk management. And I know you like to work with entrepreneurs as well. And the key, of course, is to managing risk. Tell us a little bit about your approach with this liability-driven investment. Where did that come from?
I was a member of the RIAA, which is a Retirement Income Industry Association. And how I got there was one of my professors in grad school, a fellow named Francois Gaudin, started the organization. And a lot of the guys in that organization had this mentality around a severe, extreme focus on risk management. So Zvi Bodhi, a professor at BU that a lot of financial planning people know about, and Francois really got into my head emphasized something I'd already thought of, which is how to kind of plan things from a risk management standpoint, not from a go for broke standpoint when it comes to planning.
Right. And so what does this kind of liability-driven investment approach look like if you were taking a client through it?
In one sense, it could be defining your exact needs each year of retirement and making sure there's going to be that amount of money for each year of retirement. So, for example, if you know you're going to need $50,000 at age 72, planning right now to make sure the 50 is definitely there at age 72. And however you have to do that, that would be the planning to make that happen, as opposed to just throwing money into a retirement plan and hoping it grows to that point. This is just taking a more defined approach to get to the goal.
Right. And I think a lot of people probably find it intuitive to try to maximize their wealth, but that might not be the goal, right? The goal is to be comfortable in retirement, to meet your needs at that point in time. So how do you typically structure things so that they're more likely to achieve their outcomes, not necessarily maximizing their wealth?
Yeah, that's a great question, because obviously if you tend to define things, there's a good chance that if everything goes well in the markets, you would have more money just leaving everything in stocks than you would trying to define the plan. But we're not going for maximized inheritance for your kids. We're going for maximized certainty of you being, having a dignified, comfortable retirement. And at different levels, if you have a lot of money, you can use what I call the pile theory, which is just leave all your money in a pile of stocks. You can do that if you have a lot of money, because even under severe corrections, you still will probably have enough money to live off of. The further down you go in the asset range, or the higher your goals are compared to what your assets are, the more you might want to define things. And for that, it doesn't matter which financial instrument you use, but the planning process behind it is simply saying, I'm 30 years old right now, and I know at 60, I want this amount of dollars. What do I have to set aside right now to take care of the year I turn 60? And then thinking about each year separately. What do I need to set aside for the year I turn 61 and 62? And taking that approach to defining your cash flow in the future, as opposed to hoping it's going to be there by just investing in a market.
Right. And the one thing I love about that approach is it's agnostic to the types of solutions you use. So once you define the goal, then you can figure out, do investments make sense? Does insurance make sense? Do annuities make sense? But without knowing that goal, it's hard to really figure out what's going to be the right instrument to achieve your ultimate objective. Let's talk about a client that you worked with. I know you had a case study. This might illustrate the concept that you'd worked with through this approach. Tell us a little bit about your client. That's
a great question. We had talked about Jim. And I told you the reason why I will call him Jim is because that's his name. And his situation, the question was really simple. He was a bit overfunded for retirement, so he certainly could have left money in the market. But I put the question this way: would you rather leave the money in the market, and you'll likely hit your goals? You'll have an 85% chance of hitting your goals, and you'll leave a good size inheritance. Or would you prefer to have a more defined plan where we would target a lower rate of return, but the chance of your success approaches 100%? So would you want a 100% chance of success with a smaller inheritance for the kids, or an 85% chance of success with a larger inheritance for the kids? And being kind of a risk-focused guy himself, I'll let the viewer decide, which way he chose. But I'll give you a hint and say he liked the idea of certainty. So that was, so that really what it provides people is this ability to be more sure about their future.
Right. And as you and I talked about, sometimes even if you have less wealth, for example, it may make sense to be more conservative given your goals, because each dollar is more important to you. If you have more wealth and you want to, compare yourself to your peers who are investing in the markets, make sure you set aside the right amount to make yourself comfortable. And then with the excess, you can be a little bit more risky with it, again, because you have your plan locked down. But that's probably a better way of thinking about it for most people who really don't want to run into a situation where they're running out and then they have to go back to work, for example, when they're older, that type of thing.
Yeah, I think we talked about that as you get more constrained with your level of fundedness, how much overall wealth you have to your goals, you actually want to go counter. Instead of trying to make more money, you want to get counterintuitive and get more certainty, because the chance of somebody who's more constrained having the risk of spending a chunk of money and deteriorating their retirement situation, or having that delinquent child come along and ask for $25,000 and further, the chance of that is very high. So if you can kind of more define your income, and for those people, sometimes an annuity is the best bet because they just know how long they live, there's a check coming.
Yeah, absolutely. Well, thanks for joining us today. I'm sure we're going to have you on for future episodes. You have so much to share here. I really appreciate the time.
Yeah, thanks, Mark. I appreciate it.